Welcome to Understanding the Numbers, a series where we break down the key stats and values that every investor should know. These are the numbers that you see on every stock screen, and once you understand the meaning behind these numbers, you'll understand investing a lot better. So let's get into it. One of the most common numbers you'll see when researching a stock is the PE ratio, or the price to earnings ratio. It sounds complicated, but the idea is simple. The price to earnings ratio is the amount that investors are willing to pay for $1 of a company's earnings. It's a quick way to understand how the market values a company's future potential. You calculate the PE ratio by taking the stock price and dividing it by the company's earnings per share. A higher PE ratio usually means investors expect stronger growth in the future, so they're willing to pay more for the stock right now. A lower PE ratio might mean the company is growing more slowly, facing challenges, or simply being valued more conservatively. But here's the important part. A high PE doesn't automatically mean a stock is overpriced, and a low PE doesn't automatically mean it's a bargain. Different industries have different norms. A tech company with fast growth might naturally have a higher PE, while a utility company with slow, steady growth might have a lower one. That's why PE is best used to compare companies within the same industry. PE ratio also gives you insight into investor expectations. If a company misses earnings but still has a high PE, the market might still believe in its long-term story. On the other hand, a drop in PE can signal that investors are losing confidence. There are also two types of PE ratios. You may see trailing PE, which uses actual past earnings, and forward PE, which uses estimated future earnings. Forward PE is helpful when you're trying to understand where the company might be headed, not just where it has been. So while the PE ratio isn't the only number to look at, it's a valuable tool. It helps you understand how the market views a company's earnings, compare similar companies, and judge whether the current price lines up with the company's growth potential. When you understand PE, you're one step closer to reading the market like a real investor.